let us now move on to the last portion of our program, which is the discussion about our local stock market. So we invited someone very interesting since he actually is managing what is currently the best performing local equity mutual fund in the industry year to date, which is the Atram Alpha Opportunity Fund. So he is relatively young, but that's something that has not hindered him from garnering extensive industry experience in his roles as equity analyst and portfolio manager, covering various sectors such as power, utilities, infra, cement, property, banks, and conglos. So he graduated with a degree in mathematics from UP and is currently head of equities research at ATR Asset Management. Ladies and gentlemen, let us all welcome Mr. Elle Jamil.
Hi, Serge. Hi, everyone. Thank you again so much for carving out a portion of your time to listen to our thoughts about the local equities market. Hold on, let me just share my screen, and we'll jump right into the discussion. Yeah. So I think my colleagues before me have already delved into a lot of what's been driving the different asset classes right now. So we'll just breeze through the first few slides. But before we begin, where do we stack up against the region right now? This was taken at the end of May. The Philippines is up by 1.5%. We're currently at the middle relative to the region. As of today's closing, we're actually down 2.5%, and that's still about at the middle or even to the bottom range of the region. And as you can tell, our stock market hasn't really gone anywhere. We're currently trading at a tight range between 6.4 to 6.6. We reached as high as 7.4, 7.5, but there's always 7.5 seems to be our strong resistance. And for the longest time, for the past few months, we've traded between 6.4 to 6.6. And that's because the PSEi performance correspondingly with inflation figures. But as the two colleagues before me has discussed, further inflation deceleration could improve this sentiment. As inflation decelerates, we see the currency at a stable range between 54 to 56, just a peso wider than Richie's expectation, which is still an improvement from last year. And this is very important because we need foreign money to come back. The first thing, probably one of the first things that foreign fund managers look at whenever they invest at like an emerging market is the risk to the currency, right? Last year the peso depreciated by about 7%, as much as 7%. For us to be able to attract foreign fund flows again, the currency has to be stable. And from a bottom-up approach, the first quarter 2023 earnings, which is currently supporting the market, and we'll see later on how much at least the PSEi companies stacked up as of the first quarter. So we are seeing inflation on a downward trajectory, and again, it flows to the BSP terminal rate, basically. And we still see it decelerating towards the end of the year, but to a much more meaningful downward trajectory by next year. So towards the second half, we might see the BSP still holding the rates, which is the key, one of the key factors that we're looking at, as my two colleagues discussed earlier. Again, going back to the currency, right? We're expecting 54 to 56, 55 by the end of the year. It's even at the tighter range here. To be more specific, as of the first quarter of 2023, the peso traded at 54.86 against the dollar. And then we expect this to be at 55.50 at the second quarter, 55.25, and finally ending the year at 55. And actually a slight depreciation by 2024 at 56.50, but not to the extent anymore that we saw last year. But we are looking at a couple of cases, right? The base case is that the China reopening and the US recession will offset each other to an extent. The bull case is both the Fed and BSP pause, allowing stability and fundamentals to exert more influence. and the current account deficit narrows to 4%, which would reduce the dollar requirements to service the twin deficits, which is the fundamental pressure on the currency, right, on the peso right now. Bear case is that the Fed resumes aggressive rate hikes in 2023, widening interest rate differential. One of the other points that we identified earlier was the corporate earnings, and it's actually pretty strong. Just to give you context, Atram expects 17% earnings growth for this year, and that's just the growth of simple sum of earnings. And for the first quarter of 2023, the PSEi components actually reported an aggregate core earnings growth. We look at core earnings of about 27% year on year, and even accelerating quarter on quarter at the 29% clip. Versus our own estimates, we have about 57, a little over half in line, close to a third beat our expectations, and only 17% miss. And relative to the street expectations, we were just slightly better. The street misses versus the street was about 20%. In line was about 67%, and the beat of about 13%. So we tend to be on the more conservative side relative to the street. As of the sectors that outperformed, power, consumer discretionary, banks, property, and conglomerates showed the strongest performance. But again, this is considering that the first quarter of 2022 was a low base, especially for consumer discretionary and property. And then conglomerates were also driven by the property and banking arms, right? And to an extent, power was also an underperformer in the first quarter of 2022 because of unplanned shortages. And then residential properties are priced on higher than expected cancellations. So this is to the downside, but pre-sales trend is in line. And we highlight this because of all the sectors that we're looking at, ex-conglomerates, property still lagging, right? While banks would lead the performance. Cement volumes down mid-single digits, and consumer results, adjusting for price increases, post underlying challenges. So we're already starting, we already saw from the fourth quarter of 2022 and again towards the first quarter of 2023 that the high inflation is actually affecting consumer spending. So the consumer basket is either getting smaller, or the corporates are actually seeing down trading. So that's from normally buying a more expensive brand to maybe going to cheaper substitutes. So that's what down trading means. Sorry, just going back to the earnings. So the main lines, how do our main concerns translate to corporate earnings, right? So first would be the top line. And I've mentioned before earlier how inflation and higher prices would affect the consumption power, the spending power of consumers. Second would be the input prices, right? The margins. So the cost to produce goods got more expensive in 2022, and that was mostly the challenge back in 2022. We've seen key commodity prices continue start to trend down, continue to trend down. As in response, the corporates adjusted their prices, plus a correction in the prices of their inputs, so their margins were starting to recover. So that partially offset the weakness in the volume. So this basically goes to the revenue line. And the third line would be how it affects the borrowing costs of corporates. So that is tied into the interest rates that Richie discussed earlier, right? So when corporates are starting to feel some tightness in their cash flows, and they need to supplement their capital with borrowing, then it costs a lot more now than it was before. But corporate earnings are still relatively better than the region, and are actually relatively better than expectations. So then we talk about how the market trades in terms of valuation. So this basically tells you like the sentiment of the market, because the multiple is how foreign investors express the sentiment of the market, right? And we're currently trading at just 12.5 times, and this is at the end of May. I think as of today, we're just a tad below 12 times. And this is versus our 10-year average of 17.3. So this is even below 2 standard deviations of our 10-year historical. As 2013 was when we got when the Philippines got upgraded, our investment grade upgrade. So that seems to be a fair horizon to compare. And we're 2 standard deviations below that. So what that tells you is that we're relatively cheap compared to historical averages, right? We're currently at the cheapest level since the 2020 pandemic. And robust earnings growth is one of the main reasons for the low PE, because PE is like basically price over earnings, right? And if your earnings is growing at a robust rate, then naturally that fraction gets smaller. And inflation concerns this year have kept us cheap. So if our earnings are very good, why aren't corporates why aren't fund managers buying us? And that translates to our low PE. So, jumping into our expectations, right? I've already mentioned to you that our corporate earnings expectations for this year is about 17%. Now, it then becomes a question of what multiple should we trade in. Our base case is that we should trade at 15.8 times, and this is still 1 standard deviation below our 10-year historical average, and that already reflects some bearishness. That we're not exactly at the best risk on environment yet. I think Zach mentioned earlier that if you're looking at emerging markets relative to developed markets, and even the Philippines relative to the rest of the emerging markets, still pretty small. So it requires some the perfect environment basically for us to be really back at 18 times. Right, so that's why we're still pretty conservative in the way we assign the multiple for the fair value of the market. So at the 17% earnings growth clip, and just trading at 15.8 times, our fair value is already at 8.1. Now, this is not exactly, we're not going to get there the straight line, right? There's still a lot of factors that come into play. The main theme of this entire webinar is like just powering through uncertainties, right? So we are looking at a couple of pit stops basically before we get to 8.1, right? So we're just a tad below 6,400 now, I think. The range is 6.4 to 6.6. Our next stop would be between 6.8 to about 7.1, right? And then we have to get some legs for a stronger rally. So from 6.8 to 7.1, if we can stay within that range, the next pit stop would be 7.4 to 7.5 before we get stronger legs, like a stronger risk on environment where the Philippines gets more attention, not just from passive flows, but also from not just from active flows, but also from passive flows before we get to 8,100. Now our bull case, which is like just getting into our 10-year historical average and earning and growing at just a tad higher clip at 20%. So not only are we incorporating a more bullish sentiment, which is expressed to the multiple, but also with some bullishness in terms of corporate earnings, we can get to 9.3. Again, these numbers look very rosy, and it's not going to be a straight line. But these are also very, I don't think they're very unreasonable assumptions, right? And our bear case is actually at 5,600. And what does this impute? Earnings will be flat. And if we take cue from our first quarter 2023 earnings growth of about 27% already, it takes a significant slowdown for the rest of the year for us to be just flat in terms of earnings. Now, it's not completely improbable, but in terms of probability, it's kind of small. And to get to 5.6, we also incorporate a bear multiple of 12.8 times. And this is the multiple that we saw back in the GFC for the market. Now, having those two, 5,600, 9,300, this range actually reveals the attractive risk-reward profile of the index right now. You look at the index at 6.4, your downside is at 5.6, and you're in an upside of not even 9.3, but just looking at 8,100. This actually reveals a very attractive risk-reward profile already. So yeah, I think that was the last of my slides. And just to summarize everything, I know that yes, that there is still the near to medium term play. There's still a play with fixed income, and as Richie mentioned, after that, that's when the baton gets passed to the riskier asset. That's when you get to equities, right? And what are the supporting factors right now for equities? We have improving macro fundamentals. We have robust corporate earnings. Valuations are cheap. We rarely see the market trade at these levels. And something that I missed to mention before, low foreign ownership. The foreign ownership of Philippine corporates on aggregate was about 30% at the peak. We're currently just a little above 20%. So we've lost 10% foreign ownership because of outflows, right? So you want to get ahead of that. And as my colleagues before me have mentioned, it's really hard to time the market. So again, cost average, right? And if you look at the Philippine stocks right now, a lot of them are cheap. A lot of them are cheap. So maybe I'm preempting a question here, like, is it time now to go into Philippine equities? Timing the market is one of the most difficult things to do. And it's really hard to get that right. And the very wise thing to do is just to cost average. Right. So yeah, that's the end of my presentation.
All right. Yeah. Thanks, Elle, for that presentation.
No problem.
For at least painting a somewhat semi-constructed picture of what is a bleak local market. So di ko kakalimutan yung 8-1.
Yeah.
Anyway, sige. So to move on to our questions, just some personal ones on my end, and I think maybe a lot of audience will also echo the same. So you alluded to it, but the stock market has remained cheap, and at this point, it really looks like sentiment. It's not with the stock market these days.
Yes.
As a local equity fund manager, how do you think should investors position themselves into the local stock market? Would it be like, let's say, maybe buy direct stocks on at the time, or like do they cost average as you just mentioned?
I mean, yeah, if you look at the where the broad market is at now, it's very cheap, right? And then you look at individual stocks. There are some that are quality companies that are even cheaper, that are even cheaper than the broad market index, right? So if you're just starting out, you're not really familiar yet with the individual companies, you can just buy the broad market index and cost average there, right? Buy an index tracking fund, which we actually offer. We have an index tracking fund, just to get your feet wet, right? Before you start venturing into like individual names, and more funds that would have stronger convictions in a couple of names, right? And that comes with like doing your own research, for example. Just you don't have to cover all 30. Like you walk around the city. You look at a couple of brands, or just think about the top of name brands that you run into your day-to-day life, right? Like, do you eat fast food, or do you have bank accounts? Do you own property? Are you renting property, right? And then just wonder, like, how do these companies work? And then look at their financials, and then eventually delve into like the actual valuations of these companies, right? So that you get stronger conviction when you buy into individual names, right? So, but starting to get your feet wet, buy a broad market index.
All right. Okay. Sige. I think we might have a question which pertains to index funds later on, but we'll touch on that. We'll touch on that in a bit. Sige. So I have questions of my own, but I think that we might have a lot of advanced questions on hand. So maybe go through that first, and I'll just supplement in case we have more time. So questions on expectations on the Philippines. Ayan.
Yes.
From Jerome, when do we expect the Philippine stock market to go up?
Okay, the $1 million question, right? Okay, so couple of factors that we're looking at fundamentally. Well, let's start with the bottom-up approach, right? So, and it's not exactly bottom-up, because we're just looking at our own country, our own domicile. Inflation, which has started to taper off. The BSP just announced that they're standing pat with the policy rates. So, what you don't want, especially for equities, is for interest rates to keep going up, right? Because that makes equities relatively less attractive. For example, relatively less attractive. Of course, you look at banks; they would thrive in a high interest rate environment. But broadly speaking, for the asset class, it's bad for the local stock market. But we've seen interest rates taper off, inflation taper off, interest rates taper off. But as my colleagues before me have mentioned, we're still looking at, like, for example, the US trying to keep their inflation back down to 2% so that they can start cutting rates, and our BSP can also start cutting rates, right? Because we can't, the danger to cutting ahead is it shows up in our currency. And as I mentioned earlier, if foreign funds look at the Philippines, they have to take a look at the currency also, like, right? If it's in danger of depreciating further. So you need those things to line up, right? But fundamentals wise and valuations wise, we're already at, like, undemanding, I would say, undemanding valuations. It's very rare to see our market trade at these levels. It's so hard to time the market. That's always what I say. It's always like, when is the age-old question. If you asked me this question last year, I would say this year. But now you're asking me this question this year. I'm pushing it. We're pushing it back. The market's pushing it back, right? Yep. So if you knew when, we'd be millionaires, billionaires by now. But as we continue to be receptive to new information, and we continue to adapt, right? But that's what we try to plot anyway.
Yeah, thank you for that. Yeah, that's true. No, so the when component, that's always something we don't know. And if we're just talking to our chairman in the company, yun nga din yung answer niya all the time when we ask him the question. Kung alam ko lang, mayaman na ako. Sige, so given we don't know when though, exactly, I think you mentioned and you touched on already on interest rates, but, like, maybe aside from that, do you still foresee any fundamental changes that you need to see for the Philippine stock market to turn bullish?
Okay, I mean, fundamental changes would be, like, first the corporate earnings. Okay. We need to, and that's what we always do with our research team, that we always keep in touch with corporates just to be ahead, or just to have a feel on the ground, right? Because the longer interest rates are high, the longer inflation remains high, the more it endangers the corporate earnings. And once that starts getting affected also, then we lose the argument, the bottom-up argument already, right? So then it becomes sort of like looking at the Philippines as sort of like a value trap, basically. Because, like, yeah, we're trading cheap because our earnings are not that good. We don't want that. For now, earnings are still pretty good, right? And there are a couple of things that the government is doing. So this is more on what do you call this? More on the policy side, right? Opening it up to opening up the foreign ownership of a couple of sectors that would entice more foreign money to come in, more investments to come in, right? Because we may be in a bearish environment, but it is the most bearish thing if, like, the corporates stop investing on themselves, right? Yeah. So you want continuous investment just in anticipation of, like, the recovery, right? So,
okay, yeah, thanks for that. So yun, guys, so we need to continue seeing the SMs, ACs, ALIs of this world to continue growing. We have two questions here from Jose and Victoriano Jr. on the left side, which I think was asked earlier in the segment, but Zach deferred it. So I'll throw it to you, no? So I think the gist of the question. So what are the reasons why the Philippines is lagging behind other global markets around the world? And in fact, si Victoriano expounded it on in here. Why does the PH market keep on going down while the
Yes.
US market is going up? So specifically noticeable since Independence Day, June 12th.
Yeah, yeah. Okay, so few things would be, it's really especially relative to the US, it's a dollar strength, right? So flipping the currency narrative from like peso weakness to dollar strength, which go hand in hand, right? Well, when we talk about local equities, we talk about the peso depreciating, and we talk about like how the US market is going up. Part of it is dollar strength. But like as Zach mentioned earlier, a lot of it is being just propped up by seven names, the mega tech names, right? We don't exactly have that. We don't exactly have those types of companies. We're still largely traditional, right? Largely still driven by property, banks, and the conglomerates that own them. And just going back to the first question, why the Philippines is lagging behind other global equity markets around the world, we are still an emerging market. And whether we like it or not, we're still beholden by movements in the developed markets, right? And also, if you look at major indices around the world, for example, MSCI, if you guys are familiar, or FTSE, right? EMs relative to DMs, and then the Philippines relative to emerging markets. The Philippines relative to emerging markets is very small. It's very, very small. That if foreign fund managers want exposure in the Philippines, they just pick. They're not gonna buy the entire index. They'll just buy one representative, two representatives, right? And that's not going to be enough to carry the entire index up. So that's one of the reasons why we're still lagging behind it. So, but like when the tide turns, right? When the tide turns, with liquidity, and also that's also one of the factors, right? When foreign funds look at emerging markets, especially and specifically the Philippines, they look at liquidity. They want to be able to move their money without significantly moving the market, right? And the Philippines is sadly one of the more illiquid markets in the region, and especially relative to developed markets.
All right. Yeah. Thanks for that. Explanation, Elle. Maybe we could move on to the next question. Okay.
Yeah.
Okay. Go ahead if you have something to add.
No. It's okay.
Okay.
Sorry.
Sige. Ito. So questions on the end of the bear market. So Bea is asking, what are the signs of a bearish reversal, and what are the stocks that will benefit in a reversal situation?
Stocks that will benefit in a reversal situation. So there are a lot of stocks right now. So what's been propping up the market so far? Okay, let me just contextualize the answer. In a high interest rate environment, it's been the banks, right? So you have your BPI, BDO, Metro Bank, and then either one of Security Bank or Union Bank, right? I think it's been Union Bank has a better performance relative to Security Bank. And that's because that sector thrives in a high interest rate environment. But the flip side of that is that, for example, property companies, like your mortgages, get more expensive. So the more cyclical companies, they would have a harder time thriving in this kind of environment, right? So the stocks that will benefit in a reversal, I would answer the first question first, would be a reversal of that. So the cheaper ones, property, for example, it's been a laggard for maybe 2 years, 2 to 3 years, right? Relative to banks, relative to like even power and utilities are just steady. And then the conglomerates that would own the property companies also, because conglomerates are just judged as a sum of their parts, right? They're valued as a sum of their parts. So the bank arm is already performing well. What about the others? So they usually have a cyclical arm. So I would expect property and conglomerate arms to benefit in a reversal. Because like if you also look at the makeup of the index, still largely property conglomerates and banks, right? And then you have a handful of consumer discretionary names there. So it's so hard for the PSEi to go to, say, 8-1, our fair value, if property names and conglomerate names are still lagging, stay where they are now, right? Because that means the lightweights would have to fly, which is a harder scenario, right? No signs of a bearish reversal. I think what do you call this? It really goes back to when we look at our interest rates and we look at the earnings yield of the market, right? I think at some point in 2022, that spread reversed. The spread reversed, so it means that the bond yields bonds were relatively more attractive. But now that spread has returned to our historical spread of about 100 basis points. That means that bonds are now equity now has a proposition, at least a proposition relative to bonds. So I think that could be enough for a bearish reversal.
All right. Okay. Thank you for that. Okay. So questions on funds this time. So from Erica Christine. Yeah. So you talked about index funds just a few moments ago.
Yeah.
Is it true that the equity index fund is the best fund to invest in? From
yes, and I would venture further that it's the Atram Smart Equity Index Fund. Okay.
Could you explain that further? No, it's okay.
I have to do my job. No, okay. So the best fund to invest in. Okay, it depends. No, it really depends. On your investment objective, and your risk profile, right? The equity index fund, especially the index trackers, are for those, again, those that are maybe just starting out. They want to get a feel of how the stock market works, right? And they're just coming from safer assets, so from bonds, just moving into the stocks. And I would say, since you're already venturing into equities, the riskier profile, you're moderately aggressive, right? You're willing to take on more risk, but not really going into the far end first. So your investment objective is really first maybe just to try it out, or just to you have a medium to long term objective, and just to grow with just to be able to participate in the growth of the economy, right? And the recovery of the Philippines out in the pandemic. If that's your investment objective and that's your risk profile, then yes, it is the best fund to invest in. But if you get more aggressive, once you think you can take on more risks, right? And you still have a medium to long term horizon, but you've seen the growth of our economy and how the Philippines handled its way out of the pandemic, out of the crisis, and you want the best of the best, basically the ones that have really capitalized capitals over the pandemic period. So for example, you have a couple of blue chips, right? And then you get more selective, you get more aggressive in the way you select. Then we have a couple of equity funds also that would be more appropriate. So for example, we have our Alpha Opportunity Fund that identifies small and mid cap companies, which actually thrive during this period when the main index, the blue chips, have languished in this type of environment, and stock picking became more apparent. So that's when the Alpha Opportunity actually thrived, because it was able to identify which maybe there were some smaller mid-cap companies that were doing moves over the pandemic, right? And that actually happened. We've seen some mid-sized companies grow exponentially over the past 3 years. So if that's your cup of tea, then I would say something like the Alpha Opportunity Fund would be the perfect one.
All right.
So really, it depends on your risk spectrum.
Depends on where you lie on the risk spectrum. Yeah.
Yes.
Thanks for that, Elle.